welcome to this week's edition of MFB News. I hope you're very, very well and are regaling in the warm, glowy feeling that came from having a lovely long weekend. I certainly did. Shame about the weather, but British bank holidays, what can I say? Sorry not to be with you last week. I wasn't very well. COVID seems to be doing the rounds again. So apologies for missing last week. But actually, to be honest with you, we didn't miss much. And I'll go on to explain to you a bit more in a moment. So in terms of what we've got for you this week, we're going to do our usual roundup of what's been happening with the good old swap rates and lender pricing. We're then going to talk about house prices again. There's lots and lots of chatter about what's going on with these at the moment, so I think it's definitely worth just delving into, particularly for those who are thinking about investing in the next 12 to 24 months and trying to kind of pick the right time. We're going to talk about the Renters Reform Bill, everyone's favourite subject, and then we're going to round things off this week with a prediction on interest rates, the latest one, based on all the different factors that kind of go into setting those. So kind of giving you the latest school of thoughts of what's going to be happening there. Okay, so first up in terms of swap rates, no real news unfortunately. So as of 10:30 last night, which would be Tuesday evening, 5-year SONIA swaps 4.034, incidentally 1 month ago 3.874 and 1 year ago 3.993. So the 5-year swaps are sort of hovering at the moment between the kind of just tipping over 4 and 4.2-ish%. 2-year swaps, very similar story, so 4.546 as of last night, 1 month ago 4.405 and 1 year ago 4.452. So essentially it feels like we haven't really made any progress in the last 12 months, which is incredibly frustrating. Now in terms of lender pricing changes, I think pretty much every single lender over the last 2 weeks has increased their rates by up to or around 0.2 to 0.3%. That's generally the direction of travel. Now there have been some lenders that have made bigger increases. There have been some who have actually made some small reductions. Latest one to do that incidentally was Keystone Property Finance, who announced they're shaving some margin off their rates today. But the reality is that I'm not going to go through every single lender that's made pricing changes because it would be so boring because there's so many of them. So I think probably what's more beneficial for you is just to kind of give you a roundup on where pricing sits more broadly across the market. And as per previous weeks, what we're going to do is I'm not going to give you the cheapest rate, which has got a 5% fee, a 7% fee, or even in some cases a 9.99% fee, because quite frankly, most of you don't like those. So what I've done is I've looked for the lowest interest rate where the fee is 3% or below. So if you are an individual with a portfolio of less than 10 buy-to-let properties looking to mortgage something quite straightforward, so a non-HMO, non-multi-unit, that kind of thing, your 2-year fixed rates are from 3.89% with a 3% fee. Your 5-year fixed rates are now from 4% with a 3% fee. And your tracker rates, because we're seeing a lot of people interested in those things that are linked to base rate, because we're still talking about a potential base rate reduction in time to come, more on that later. 5.34% with a 3% fee. And then just repeating the exercise, but this time limited companies, HMOs, multi-units, and those with portfolios of more than 10 properties. Here's what you're looking at the moment. So 2-year fixed rates from 5.05% with a 3% fee, 5-year fixed rates from 5.49% with a 3% fee, and your tracker rates from 5.82% with a 2.5% fee. So that's kind of where we are at the moment. Now, I'll come on to interest rates in a bit more detail later on to give you some thoughts about what we're expecting to see over the coming weeks. In terms of lender other activity, there has been a bit of tinkering of criteria, and actually there's a couple of changes which I think are probably just worth mentioning. So firstly, Virgin have reduced their minimum mortgage term down from 7 years to 5 years. Now 5 years is actually the standard term, minimum term rather, but Virgin had theirs at 7, so they've dropped it down to 5. Now the reason this could be beneficial is if a lender's lending policy says that you have to be no more than say age 80 at the end of the mortgage term. If the minimum term of the mortgage is 7 years, then you can be no more than 73 years old when you apply. Whereas if it's 5 years, you can be 75 years old when you apply. Now, what's quite interesting with Virgin is they don't have a maximum age or maturity. They have a maximum age on application, which is 78. So quite why they feel this makes a big difference, I'm not entirely sure. But just to kind of let you know that's happened. Now, Zephyr Home Loans have tinkered with their rental calculations. So on their 2-year fixed rates, and this is interesting because normally it's the 5-year fixed rates where you see lenders flexing some kind of discretion in terms of the calculation they can use. And the reason they can do this on 5-year fixed rates is because it kind of fits within the guidelines set out by the FCA and the PRA. But 2-year fixed rates, they're now stressing at the higher of the pay rate, the rate you're actually going to pay plus 2% or 5.5%. Now, given where interest rates are at the moment, it's going to be the pay rate plus 2%. And lastly, the mortgage works have made a change, which is where if you have a limited company purchasing a property, and the property is currently one of the shareholders or directors' main residences, they can now consider lending. Previously, they couldn't do this, and actually most lenders will do this, but the mortgage works have now come into that kind of arena. And the mortgage works are a lender who price very competitively, normally speaking, because of the way they're funded, because they're part of the Nationwide, and therefore they have access to savers' money rather than just being wholly exposed to the capital markets, which can, as we've seen over the last few months, go in your favour or not in terms of rates. But the mortgage works do limited company lending, but it's quite restrictive. So the criteria is very narrow. So this is kind of, I think, the start of them really starting to dig into their policy and looking to see how they can adjust things to kind of broaden the number of landlords that they can kind of scoop up and lend to. So I expect to see more changes from the mortgage works coming up. So I think all in all, I'm going to describe the last couple of weeks in terms of mortgage pricing as boring, slightly frustrating. Like I say, broadly speaking, rates have increased by 0.2 to 0.3%, and we'll come on to that in terms of where we think things are going to go to over the next few weeks in a few moments. Okay, house prices now, and it's kind of, you're kind of caught between the devil and the deep blue sea, aren't you? For those of us who own property, we don't want the values to go down, but those who are waiting to invest do. So I think actually this week's fairly neutral in terms of the update. So what Halifax, who have just released their latest house price index, have said is that prices remain stable in April, and they increased by just 0.1%, which in monetary terms is circa £200, which means that the average price now for a property in the UK is £288,949, which compared to the start of the year where it was £287,224, so a very, very small increase. Now, what they have commented is that while borrowing costs do obviously remain higher than they did than a few years ago, buyers are actually really starting to gain confidence in what is a relatively stable market. Activity and demand for buyers and sellers is improving, and mortgage applications are now at an 18-month high. So the market feels like it's starting to kind of really warm up. If as expected, and there's downward moves in bank rate coming in later this year, then fixed rates will reduce, and this combined with resilience in the market lead Halifax to predict a modest house price increase in 2024. So there you go, that's the Halifax's latest kind of views on the housing market, both now and to the end of this year. Now, looking forward more broadly, Savills have actually published some commentary on this, and what they're doing is they're forecasting a price rise of 21.6% over the next 5 years. And they're doing this following the positive signs of improved buyer demand and a stronger than expected year so far. They've also revised their forecast for 2024, up from minus 0.3% to positive 2.5% growth this year. And this is largely on the back in the fall in mortgage costs and a slightly improved economic outlook. So I think what we can take from this is that actually, whilst mortgage rates are not where we'd like them to be, people are kind of getting more used to them. We've also had wage inflation, which is going to really kind of help soften that for people, and people's confidence in the market is really just returning. And as soon as confidence returns, as we all know, things really start to shift. So we are expecting that probably, and again, this can be quite regional, probably house prices have now kind of bottomed out and are going to start to turn the corner. And because I'm just delivering so much cheerful news for you this week, we're going to talk about the Renters Reform Bill, everyone's favourite subject, which has passed its final stage in the House of Commons and is now in the House of Lords. Now, a couple of things that kind of came out of the latest announcements around the Renters Reform Bill that I thought were quite interesting. So first of all, MPs were pressuring the government to give an date for the end of Section 21, so the abolishment. The government have said that instead they want the Lord Chancellor to report on the court's ability to deal with evictions before they'll possibly consider doing this. So at the moment, there is still no date for the abolishment of Section 21, and there is unlikely to be one until we can really understand whether the courts can deal with the system, which at the moment we all know it can't. It's looking increasingly likely that EPCs are going to form part of the Decent Housing Standard. Other new amendments, so there's going to be a notice to quit which cannot expire in the first 6 months unless the landlord agrees. After 6 months, the tenancy will become a periodic tenancy, and tenants will have to only give 2 months notice, so a slight change there. When a valid Section 8 notice is served, the council will be obliged to prevent homelessness. Councils should not consider it reasonable for a homeless applicant to remain in a property until a bailiff warrant or writ to enforce a possession order is in place. Now, this is something that I can personally speak for. So my tenant was ordered to leave the property. The council said to them, essentially, and Section 8, by the way, is non-payment of rent. That's probably quite good for you guys to know. But essentially the council said, we won't actually provide you with a home until the bailiffs turn up. So it just kind of elongates the process. It causes a lot of anxiety, but actually for the tenant as well as the landlord. And so what the the bill is essentially going to say is that actually if someone's been given a possession order, at that point the council should be stepping in and providing them with accommodation rather than waiting for the bailiffs to show up. So that's a really big positive, and that will really reduce, I think the time to get a bailiff out once you've had a possession order ranges from sort of a few weeks to several months. So this can kind of shorten the repossession process. Now, an interesting one here, when a landlord moves back into their property, they cannot re-let it on short-term holiday lets for the first 3 months. And I said this is to close a loophole. Now, I'm being totally honest, I don't entirely know what loophole that would be, but just know that if you have got a buy-to-let property and you want to move back into it, you cannot then re-let it on short-term lets for at least 3 months. And lastly, the other thing that was kind of clarified is that the property portal is not going to replace selective licensing. Now, this is something that I think a lot of the landlord associations were really hoping, saying that actually having selective licensing and a portal is overkill. But essentially what the government is saying is they're to address two very, very different things. So actually there will be a small amount of overlap, but they're both there for a different purpose, and therefore both are going to remain. Okay, now as always, with anything that's important, there is a lot of chatter with people offering their opinions about what they think is going to happen. And interest rate movements are certainly at the top of the list of things people want to talk about and offer views on. So I thought it'd be interesting to share with you that the Organisation for Economic Cooperation and Development, so try saying that after a couple of glasses of wine, have said that interest rates should remain at their current level until inflation eases further. Their latest economic outlook suggests that no rate cut will come before August this year, when they anticipate inflation will then be at 3.3%. Now, the biggest concerns over rates currently centre around uncertainty in the Middle East and also the USA having higher than expected inflation despite not dropping their rates. Their inflation was mainly impacted by the cost of rent and gas, where prices have increased by 3.4%. So essentially, I think what's going on here is that actually the US is kind of seeing their inflation increase rather than decrease. And so there's a concern that actually, while we've seen our inflation come down and down and down, is that going to be the case, or are we going to kind of have a ripple effect, which is often the case. If something happens in the US, it tends to kind of come across the pond to us, and we'll see inflation kind of tick back up again. So that's why the markets, or essentially people are saying that actually base rate isn't going to go down until inflation has come down further and is looking very settled. So we await the inflation data coming out eagerly. Now, in terms of swap rates, and so your fixed rate mortgages, this is essentially what's going on here. So real concerns about mainly the Middle East and also watching what's going on in America, and therefore the sentiment that base rate is going to stay where it is for a longer period of time, and that has knocked on to fixed rate pricing. So as always, when we get the latest inflation data through, assuming rates, so inflation has come down a bit, that will certainly help sort of renew confidence. But at the moment, things are still feeling very, very delicate, and the markets are obviously just kind of really playing very, very cautiously. So I think the message is in terms of when a rate's going to start coming down. I think realistically, any kind of meaningful movement in terms of fixed rate pricing, you're looking at least really 2, maybe 3 months, I'm afraid. And that's everything for this week. God, I feel like such a doom and gloom merchant at the moment. I'm really sorry, but hopefully, like I say, we will start to see things improve over the coming couple of months. Right into the middle of summer, we'll be rejoicing in the sunshine and also talking about how low interest rates are, fingers crossed. But for now, as always, there's lots of you who still need mortgages and remortgages, and people who are actually buying. We're definitely seeing an uptick in the number of landlords who are investing. At the moment, recognising that probably we're at the bottom of the kind of market in terms of house prices, and things are going to start to increase. So there are still lots of people looking for mortgages. So if you do have anything you'd like to talk to us about, please give us a call, 0345 345 6788, or have a look on our website where you'll find absolutely oodles of information. Have a fantastic week. I'll see you again same time next week. And enjoy this beautiful weather.